Um, we finished with a discussion of hedging in the exchange rate market, the currencies. I have two examples from the financial markets, and then I would like to explain the concept of an optimal hedge, which will be our last topic on the hedging side. So I sort of introduced this example last week, and it's very common in the financial sector. Here we have a situation where a savings and loan or a bank or something like that, a financial institution, agrees to purchase some home mortgages. And I have the value set at $1 million, and in today's market, that's not many houses, okay? It's a couple of houses in Davis. So this bank or S&L agrees to purchase the mortgages from the building contractor. The contractor is under construction. He's building these homes and is concerned that the interest rates might rise because the rates are at an attractive level, and he knows that he can sell the property as long as he can offer the buyer a mortgage at a reasonable level. So if the interest rates are currently at 8.5%, the contractor approaches the financial institution, the S&L, and says, will you buy these mortgages from me once the homes are complete, but I want to lock in an interest rate today. That's the whole idea. He wants to lock in the interest rate today. And so the bank is perfectly happy to do that, but most banks who do issue mortgages turn around and resell those mortgages, because typically they're for 15 years or 30 years, and the bank will repackage those and sell them into the market. So the bank is exposed to the interest rate risk in this example, because if the rates do rise above 8.5%, then it's the financial institution, the S&L, that takes a loss, because, as you know, when rates go up, the value of an instrument like this goes down because there's a fixed interest payment. So it's a long-term interest rate. Therefore, we look at the T-bond contract, because T-bonds price long-term rates. You know the contract size in Chicago is $100,000. We have $1 million instrument here, and so the S&L decides to go ahead and hedge, and to do so they would choose 10 contracts, because the contract size is $100,000 and the total exposure is the interest on $1 million. So you need 10 times 100,000 is $1 million. So we set up our problem just like we've done the others, where we have the date. It's now November. We have the cash price, the basis, and the futures. I'll give you this information. The cash price, let's suppose, is 96 and 3/32. These are in 30 seconds, which is about 8.5%. I just put that in brackets as a rough approximation. The basis is 29/32, so we have the futures on the SEP contract at 97 even. That's 97% of par, as you know from trading T-bonds. So the hedge is initiated in November. The contractor can go ahead with construction, because they can then offer these homes for sale with a given interest rate of 8.5%. The bank has agreed to offer those mortgages as 8.5%, and the bank is protected in the futures market if rates should rise, subject to basis risk, of course. And the bank is using the futures market as a temporary substitute for a future sale of those mortgages. So the bank is really long mortgages, right? It's got two of these mortgages that it's promised to buy, but it hasn't resold them yet, and it can't resell them until the folks move into the house and sign all the paperwork. So at that point, they will lift the hedge. So let's suppose that August now rolls around, and let's suppose that interest rates have in fact increased from 8.5 to 9 on the spot side, which means that the price in the futures contract will come down if interest rates rise. Our cash price also falls, and we work out the net outcome, just as we've done in our other examples, right? You're short 10 contracts, the price falls by 400 basis points, and so that's an even $4,000 per contract times 10 is 40,000. You have a narrowing of the basis, which is good for a short hedge, right? So that works in favor of the basis. There's an opportunity loss on the cash side because when the S&L goes to sell the mortgages, because interest rates have risen, the price of the mortgage will have fallen. So in terms of the net outcome, basically we compare the gain in the futures market, which is $39,250, and this is greater than the loss, the opportunity loss on the spot side, because the cash and the futures position are equally matched here, right? It's $1 million on the cash side, $1 million in the futures. So that's a nice match. So this gain will be picked up by the S&L, the gain on the narrowing of the basis. So the difference between the futures gain and the opportunity loss is approximately equal to the change in the basis after we net out the commission fees. Okay? So hedging with financials is slightly more complicated because you have the interest rate going one way and the price going the other. But as long as you follow this framework that we established last week, and as I said last week a couple of times, before you even decide whether you're going short or long over here on the action column, just put in those numbers. You put in your cash price, your futures, your basis, and then you can go ahead and complete the tableau. Okay? Any questions on this Treasury bond hedge? So, yes?
They gained about 5,000 on the futures side, but how much would they have lost in the cents?
Well, if they had not had, they would have lost 34,000 because the interest rate went up and the price that they could sell those mortgages for would have fallen. So they would have lost 34,000. In fact, they did sell them for 34,000 less, but they made a $40,000 profit on the futures, which offset that, more than offset that $34,000 loss. Okay? All right, let's do a short-term interest rate example then. This will be our last hedging example. I'm sure many of you are saying, thank goodness. Okay. Again, this is a very common practice in the financial community. Here's an example of a company, a business, that's trying to raise some funding for a project. And we could think of different ways to cook up this example. Let's suppose that you have a small corporation and it wants to construct a new building. And it looks at the benefits and costs of putting up this building. Their business is expanding, so they need this space. They could either rent or put up a new facility. They look at putting up a new facility, and it looks very favorable, but they do have to borrow money to do it, at least over the short term. So the way they're going to raise the money is they're going to issue some commercial paper. Okay? Just like the government issues paper, it issues treasury bills or treasury bonds. It's possible for commercial firms to, quote, issue paper, which is basically a fancy way of saying they're borrowing money and issuing a promissory note. So they can also go into the money market, and depending on their credit rating, their interest rate will be established, and they can basically issue this commercial paper, which is it's a promissory note. They're borrowing the money today and they agree to pay it back at some future date. And this is a very common way for these companies to borrow money, and they basically avoid the middleman in doing so. So let's suppose that it's now November and they're in the process of making this decision, and these decisions aren't made overnight. As we discussed the benefits of hedging, one of the major benefits is that it gives a firm a lot of flexibility in planning. So if you're in the planning process, you know that you just don't go put up a building. It's a very complicated process. You have to have plans drawn up, then you have to have estimates of the cost, and you have to have an environmental impact done, and this can take forever, really. So there's a long lag between the decision making and when the building's actually under construction. So this means there's a long lag between today, when they're in the process of making the decision, and the point at which they will actually issue the commercial paper. I mean, you can't sell the paper unless the building's under construction and you demonstrate that you have the land and so on. So for sake of argument, suppose the paper will be issued on February 1st next year, and let's assume they need the $5 million for half a year, 180 days, so that's the period of the loan. And now they go ahead with the decision to construct the building, but one of the board of directors says, well, hang on, we've made all these assumptions. Suppose that interest rates rise in the short run. You know that Mr. Snow was running around the world saying interest rates ought to rise because the economy is strengthening. Rates are low today, but if the rates jump up, then our costs of putting up this building have just increased dramatically, and maybe that would turn a good idea into a bad idea. So the firm is now exposed to interest rate risk once it makes the decision to construct the building, because it knows that today's rates, it could issue a certain amount of commercial paper for a fixed rate, but if that rate goes up, then the discount on the commercial paper also rises. So they decide to hedge against the interest rate rise. Now it's the company that's doing the hedging, it's not the bank. It's this company that will issue the commercial paper. They haven't issued the paper yet. That'll happen in February. So they use the futures market as a temporary substitute for the issuance of the paper. They're going to borrow some money in February. So they use the futures market as a temporary substitute for that. And they're exposed to an increase in the interest rate. And you know that on the euro dollar, the price is 100 minus the interest rate. So if the interest rate goes up, then the price falls. They're exposed to a rise in the interest rate, therefore they must sell futures contracts that would give them a profit with the price fall. The contract size, you know, is $1 million. The specifications on the contract are for a 90-day maturity. So they're borrowing $5 million. So how many contracts do you suppose they would sell? 10? Thank you. I guess I had it up here. Why is it 10? I thought it was on the next slide. Why is it 10? That's the right answer.
5 million, so you have 5 contracts, and it's 180 days, and this is a 90-day contract?
Exactly. It's the time period on the euro dollar. The euro dollar has a face value of $1 million, excuse me, and the interest is applicable to a 90-day period. So if you're borrowing money for twice as long and the interest changes by X%, well, then you need to double up on the futures positions relative to only borrowing money for 90 days. In other words, when we talked about the euro dollar, we said that because it's a $1 million face value, if the interest rate changes by 1%, that's an annualized rate, we said that the value of that instrument would change by $10,000, correct? 1% of $1 million is $10,000. However, it's only a 90-day instrument, so we have to divide by 4, which gave us $2,500 for a 1% change. And you know, if you boil that down to 1 basis point on the euro dollar is 25 bucks, right? So in other words, if the interest rate increases by 1%, the euro dollar contract only changes in value by $2,500, which would be fine if you're borrowing $1 million for 90 days. But if I was borrowing $1 million for 180 days and the interest rate changed by 1%, then it would affect the value of that loan by $5,000, not $2,500, by $5,000, because 180 days. So to protect against that outcome, I would need 2 contracts if that were the case. So here, they have a cash position of $5 million for a period that's twice as long as the futures contract specification, so they have to double up. So they have to go to 10. Yes?
Did they buy 5 contracts and then wait 90 days to buy another 5?
No. The question is, they're actually selling. The question is, do they sell 5 now and then wait another 90 days to sell 5? And the answer is no, because the rate could change at any point between now and February. Okay? So they're taking this loan out, in essence, in February. That's when they're going to sell the paper and get the money back to pay for the building. So if they make that decision today, and next week there's some announcement that comes out that the economy is even stronger than what we thought, and it turns out Mr. Snow was right, then short-term interest rates jump by 1%. If they had not hedged, okay, and this news came out and the rate jumps up 1%, and it's still a ways from February, then that 1% increase on their $5 million loan, which they'll take out in February, okay, would, and somebody help me out on the math, a 1% change for an entire year would be $50,000, right? It's for a half a year, so that's $25,000, I believe, would be the increase in the cost of their loan. Do you follow me? So the rate could change tomorrow, and if that's the case, you need to be fully hedged. And you're not fully hedged unless you have a sufficient number of contracts to cover you for your increased cost on the cash side due to a change in the interest rate. The whole idea here is you're exposed to a change in the interest rate. And if the interest rate changes by X%, it's going to cost you Y dollars. And we have to hedge that off of the futures market. And you know, it's just a matter of doubling up because of the difference between 90 and 180 days.
Well, the reason why I asked that was because, say we have them for, because even if we buy 10 contracts, those are still 10 contracts for 90 days.
Right.
And the thing is, we still need another 90 days to hedge.
Well, we're just hedging between now and February. Today we decide to go ahead with the project. It's in February that we borrow the money. We're not borrowing the money yet. Okay? So we're just using the hedge as a temporary substitute for the day we fly to New York and issue our commercial paper and borrow the money. Okay? Yes?
So you'd go short on futures 90 days before February 1st?
You'd sell them today. Sell them today because once you take the loan out in February, the loan is for 180 days. You've made that decision. You need to borrow $5 million for half a year. Okay? So if we went through the same example today, and we said, well, we're borrowing $5 million, but we only need that $5 million for 90 days, then you just sell 5 contracts. Okay? If I said I need it for an entire year, then you'd sell 20 contracts. But it's really starting from February 1st. How long do you need that loan for? And the way the example is set up, the loan will be priced on February 1st. And obviously, a given change in the interest rate will affect the pricing depending on how long you're taking the loan for, what time period. Does that answer your question?
So do you short your 10 contracts on February 1st? That's when you...
No, you short them today.
What is today? How
November.
November?
November 9th.
Okay, well, so suppose 90 days goes up, you reverse your position, and then the interest rate changes, you're effectively done nothing, right?
That's right. So you don't want to do that. You want to, so you short the market today, and you hold that position until you fly to New York and issue the commercial paper. It's no different than the soybean farmer who's long soybeans. He sells futures and holds those positions until he delivers his physical commodity, and that's when he lifts the hedge. Or the airline company that happens to be short jet fuel, they buy futures or buy options, hold that position until the same day that they actually purchase the physical commodity. So what we're doing here is we're hedging against an adverse price move between now and February. So, yeah, but that's sort of irrelevant, really.
What if you issued it in October? Then you'd
The
have
same. If I did this in August, it would be the same, because what's important is the number of days that the loan is for, okay? It's the number of days that the loan is for.
Yeah.
Because if the interest rate jumps up by 1% between now and February 1st, it's going to cost you so much money. If it jumps up by 2%. And the amount that it costs you is going to depend on, obviously, the size of your loan and how many days you're borrowing the money for. So we're trying to hedge against, basically when you issue the commercial paper, you sell it for a discount, as I'll explain in a second. And we're trying to hedge against a decline in the amount of money that you receive when you issue the paper. Is this helping?
No, I think I understand.
Okay.
The contracts don't necessarily expire in 90 days. They're just contracts for 90 days. So
That's right. And we're
so
choosing
did it in
September.
August.
We're choosing September. So there's lots of room here.
Lots of time. Okay, now
That's
that makes
right.
sense.
Yeah. Okay. So let's just go through this quickly. These questions are good because I know this is a little bit more complicated example. So today, here's the cash price. Today is November 9th. Here's the futures price. So we happen to have a negative basis, which doesn't matter. Somebody asked me that last week, and that's okay. We sell 10 contracts at 91.5, and you know on the euro dollar that this is an index is 100 minus the interest rate. So we say the cash price, the cash interest rate on the short term is about 8%. It's now February, and in fact rates have gone up. So that's what you were concerned about. So it's going to cost you more to take out that loan in February. So we say there's an opportunity loss of $28,000. You're short. The basis became more positive. It went from minus 0.4 to minus 0.3, became more positive. And when you're short, you want it to narrow, so it's actually widened, which is negative. The futures gain is $25,000 minus our commission fee, $25,750, so you end up with $25,000 profit on the future side, which is close to the opportunity loss over here, right? The difference being the change in the basis. So the cash price fell by 115 basis points from 91.92 to 90.77. There's your loss of $28,750. The futures price decreased by 103 basis points, so you have a $25,000 gain. The basis widened, which was a loss. And so what's the net outcome? Well, if the corporation had not hedged, they would have sold their commercial paper for a lower amount because it's discounted under the $5 million face value. So they picked up an additional $25,000 in the futures market relative to a situation where they had not hedged, which is very close to offsetting their entire loss. Now this next slide should help explain this example. Remember when we talked about it was really treasury bills, but this is the same idea. If you're issuing commercial paper, it's sold at a discount. It's like the U.S. government, when they sell treasury bills at an auction, there's a face value to that instrument, and it's sold at a discount. And you buy it at a discount, you hold it until its maturity, and then you redeem it for its face value. And the difference between what you paid and its face value is your effective interest, right? So if you're buying commercial paper, the commercial paper will have a face value. So in this case, it says $5 million. The corporation sells that piece of paper on the money market. Whoever buys it pays less than $5 million. They hold it for the duration, in this case 180 days, and then they redeem it and they say, okay, I want my 5 million. And the difference between what they paid and the 5 million is their effective interest. So the price on the instrument will equal the face value minus the discount. So just to keep it simple, let's start with units of $100, and then we can go to the 5 million in a second. So we start with units of $100. So for every $100 of face value that you sell, the price is equal to 100, which is the face value, minus the discount, which is the interest rate, right? And in this case, the interest rate is for a half a year. So we have an annualized rate of 9.23%. That was the spot rate on February 1st, right? Go back here. That's the spot rate on February 1st, 9.23. So we've got that interest rate times 0.5. It's a half a year. So you multiply that through, and that gives you a discount, or a price, if you like, for every $100 is 95.385. So in other words, if someone was buying this paper from you and they wanted to earn an interest rate of 9.23% annualized for a half a year, they would only be willing to pay $95.38 for every $100 that you issue, which means that the final proceeds on your paper are the following. You're issuing paper for $5 million. Let's multiply it by the discount factor, which is 0.9538. So that gives you a total of $4.769 million. That's the money you receive. Plus you get your futures profit of $25,000. So at the end of the day, when you go to New York City, you come back to Sacramento with this much money in your briefcase, right? $4,794,000. You've sold the commercial paper, you've got your futures profit, and that gives you $4,794. We've added the futures profit to how much you raised. So that's pretty good because your objective here was 8.08%. If you go back to the previous slide, that was the cash price today, November 9th. So your objective when you met in the boardroom, this was the interest rate you were looking at, was 8.08. And at that rate, you would have raised $4,798,000. But you couldn't sell the paper for this price because interest rates went up. But you came very close because of the futures hedge. You raised $4,794,000 versus $4,798,000, which is a very small difference compared to the loss you would have experienced, the opportunity lost, had you not hedged. Okay? Yes?
Widened in the last slide? Sure. Looks like it's closer to zero. That's
But it became more positive. That's just how we define a widening and narrowing. The basis can be defined a number of different ways. And what I do, I tend to call it futures minus cash. And if it becomes more wide when you're short, that's going to detract from the hedge. So they're basically moving apart. Became more positive. Okay? Yes?
We had until September, but say like we reached beyond 90 days, do we just do you understand the question? It's like ours was we bought in November and sold in February. But what if September had already rolled around and said like instead of February we sold in another year? How does that
Maybe earlier? Because it's now November 10th, I guess. I'm saying it nice. It's the 10th. It's now November 10th. We have a plane ticket that's going to take us to New York on February 10th. Okay? So that's when we're taking out the loan. So we don't want to sell a futures contract that expires before February. That would be silly because then we'd have to roll it over. Okay? But I mean, your question is, I think it was, what if you sold one that sold a December contract?
Yeah, in the sense that
Yeah.
90 days have rolled over. So you can roll over.
Yep. That's what metal shaft was doing, right? You read that story? They were rolling it over. So yeah, in theory you can roll it over. It doesn't mean it's costless, but with a hedge, yeah, the answer is yes. I mean, let's just take this example one step further. Suppose you had your board meeting today, and you decided to construct this building, but you're not planning to do it for 3 years' time. Okay, and there's no futures contract in Eurodollars that would allow you to sell it 3 years out. So what you could do in theory is you could sell the most distant one that where there's reasonable trading volume. You'd sell 10 of those, and then as that one approached, then you'd roll it over, and you keep rolling over. But it's not costless, as Metal Shaft found out, but it's a possibility. It complicates the hedge. It's not as straightforward, but it's certainly done. Okay. Any other questions on this example? Okay, the book has some other examples for you as well. And I think the best way to study for the midterm is to look at last year's midterm, last year's final, where I have hedging questions. So this next midterm will have some hedging questions. So there are 2 exams there on the website that you can look at, plus look in the book. Okay. Excuse me. So there's one final concept I'd like to cover with regard to hedging, and that's called the optimal hedge. So far, our assumption has been that if you have a given cash position, you want to hedge an equivalent volume in the futures market. Okay, if you have a cash position in soybeans that's 5,000 bushels, well, you just want to pick one contract and so on. So we've made that implicit assumption. However, in reality, it may not be the best to hedge 100%. If you notice when we were reading about the airlines hedging, I don't recall one of those airlines being hedged 100%. It's quite common in the real world to choose what we call a hedging ratio, which, if you like, is the ratio of your spot position to your futures position. That's different than 1. Typically, it's less than 100%, and sometimes it's greater, but not that often. And I'll try and explain why that is. And it has to do with a concept in finance that's the Markowitz portfolio theorem. And when we talk about optimal hedges, really conceptually what we're doing is we're saying we have a cash position. So you have a cash position, whether it's short or long, it doesn't matter. And you're really adding to your portfolio by taking a futures position. So you've constructed a new portfolio. Okay, some of you have taken finance, right, where you put together a portfolio of assets. Well, here the portfolio consists of 2 assets, cash position, futures position. This could be long or short, this could be long or short, doesn't really matter. So you're putting together a portfolio, and then it's a question of how do you devise the optimal portfolio, and that's what optimal hedging comes from. So the assumption behind this optimal hedge is that the hedger is risk averse. And let me just remind you what that means. The lay interpretation of risk aversion is that you would not accept a fair bet. Okay, if I put one of the new $20 bills on the table and asked any of you to come forward and we'd flip a coin for the 20, okay? If you lose, you pay me 20. If I lose, I give you the 20. That's a fair bet, right? Assuming I have a fair coin. If none of you come forward, that suggests to me that you're all risk averse, which is our normal assumption in economics. We assume that people are risk averse. And the idea is that the thought of losing $20 carries a certain negative utility. The thought of gaining $20 carries a certain positive utility, but the utility associated with losing 20 exceeds that of gaining 20, so you stay sitting in your seat, right? You don't come forward. That's risk aversion. So we can illustrate it with the following diagram, which is the same idea. Let's say you have $10 in wealth, and I ask you to come forward, and we'll flip a coin. There's a 50-50 chance of either losing 5 or gaining 5. So you can go up to 15 or down to 5. And because there's a 50-50 chance of 5 versus 15, if we take the expected value of those two outcomes, well, it's also 10, which is your current wealth. And if you're risk averse, you say, no, I choose just to keep the $10 in my pocket. The utility of the certainty equivalent, which is keep the $10 in your pocket, is greater than the utility of ending up with 5 with a 50% probability and ending up with 15 with a 50% probability. Okay, so that's the definition of risk averse. The utility of the certainty equivalent is greater than the utility of the expected value. In other words, if we chart wealth on the horizontal axis and utility on the vertical axis, and we compare the utility of the $10, which is this point on your utility frontier, it exceeds the utility of earning 5 with a probability of 0.5 and the utility of 15 with a probability of 0.5, which would be the 5 is down here, the 15 is up here. If we take the expected value, it's this point right here. So in other words, your utility function is concave. So that's what risk aversion is, and I'm sure you've run across it in other classes. So if we assume that hedgers are risk averse, that's a very standard economic assumption. Then given that concave utility curve, we can draw these positive sloping indifference curves for a risk averse investor. And all this says, and it makes perfect sense, that there's a trade-off between risk and return. It's upward sloping because if you take on greater returns, so you move from A to B, so you're comparing two portfolios here, okay? The portfolios are comprised of different bundles of assets, and you can think of these as being cash and futures if you like. So you've got two portfolios. There's portfolio A, it has low risk and low return. You're risk averse, so you like the low risk, but it is accompanied by low return. But if you are risk averse, it's possible that that portfolio, depicted by A, is equally desirable to this portfolio, depicted by B, which has higher return but also has higher risk. So as the risk goes up, that's something that you don't desire. But in order for you to take on that additional risk, for you to hold B versus A, you would clearly demand a higher return. So you demand an increase in this direction. So that indifference curve just captures the characteristics that a risk-averse investor or hedger would hold. Question? Oh, okay. So it's upward sloping, but there could be different degrees of risk aversion as well, right? If you're highly risk averse, then to take on a certain amount of extra risk, you would demand a much bigger increase in return versus an investor that's only slightly risk averse. They're willing to take on some additional risk without requiring that the return increase too dramatically. So again, when we're looking at this indifference curve, each point along this curve would represent a different portfolio of assets, a different combination of assets. So that captures the underlying assumption in the model. And so now we can go ahead and put together the so-called optimal hedge. So as I said, the optimal hedge, we're going to keep it simple here. We're just assuming we're moving from one asset in our portfolio to two, okay? So we have a cash position, and we're going to, quotes, form a portfolio by adding a futures position. And we're going to decide what is the optimal ratio between the cash and the futures position. And as I said earlier, until now we've assumed that it was 1. If you have 1 unit in cash, you want 1 unit in futures. But that may not be the case because of the fact that you're risk averse, and also because of the fact that futures and cash may have a unique relationship. So I say, suppose a farmer, it could be any hedger really, but the example I set up is that of someone who's long in the cash position. We could do a short hedge too. We just reverse the signs. It doesn't really matter. But we have a hedger that has a fraction h of the cash position in the futures market. Okay? So h could be 1 or it could be different than 1, which means that 1 minus h is unhedged. So if h is 0.5, then you have half of your position hedged and half of it's unhedged, right? If it's 0.8, then it's 80% hedged, 20% unhedged. United Airlines, it was 0, so they had 100% unhedged, right? Southwest, H was something like 0.8. It varies from company to company. So if that's the case, now you have this portfolio, and we'll call the return on the portfolio R sub H, for H stands for hedged, and that's equal to the return on the cash asset. And you can think of this in very simple terms. This could be just the change in price, right? So you're holding a cash position. So you're holding some soybeans. The return to the cash position will depend on the change in the price of soybeans. You've got a futures position, and this fraction H is a fraction that's hedged. So far, we've assumed that H is 1, so just pretend it's 1. If that's the case, then it's the return on the cash minus 1 times the return on the futures. There's a minus sign in front of the futures because we're assuming you're short futures. So if the price goes up, then there's going to be a positive return here and a negative return here. If the price goes down, there's going to be a negative return on the first term and a positive return on the second term. So that is your portfolio. You've got two assets, C and F, and they each have a return. You've combined them in a portfolio, and the ratio of C to F is equal to H. So we're interested in the risk of this portfolio, because the whole idea of constructing a portfolio in finance theory, I mean, why do you diversify in finance? Why do investors diversify? To reduce risk. So the whole idea is to reduce risk. So let's look at the risk of this portfolio. So we write down its variance. So we take this expression up here and write down its variance. Then we have the variance of the hedge position is equal to the variance of the cash plus h squared times the variance of the futures minus 2h times the covariance between the cash and the futures. So that comes into portfolio, and you probably recognize this from your finance class. So this is the variance of the hedged position. So we have this variance. I've just written this down again, which is variance of the hedged position. And the whole idea then, if you're trying to reduce risk, as you said, that's why you're constructing a portfolio. Well, what you want to do is minimize that expression. You want to minimize the risk. So you take the first order condition, of this expression here with respect to h, because it's h that you're choosing, right? You can set h equal to 1, or you can set h equal to 0.8. It's h that you're choosing. So we take the first order condition with respect to h. This gives us 2h times the variance of futures minus 2 times the covariance between cash and futures. Just take the first order condition of this expression, set it equal to 0, and solve for h. And you see that h star, which is our optimal hedge, is equal to the covariance between cash and futures divided by the variance of the futures price. If you recall back to Econometrics 106, you might recognize that as the same as the slope coefficient if you regress cash on futures. Remember x prime x inverse, x prime y, that's what this is from regression theory. But you don't have to remember that. But it's a way to estimate h star. You can basically estimate h star by running this simple regression where the dependent variable is cash, the independent variable is futures, and your estimate of beta will give you an estimate of h star. So it's a very convenient way to estimate the optimal hedge. Conceptually, I think it's easier to think of the optimal hedge as something other than the slope coefficient. So this was our optimal hedge, the covariance divided by the variance of futures. And if you remember from statistics, your correlation coefficient is between cash and futures, which will range between +1 and -1, right? So the correlation coefficient measures the extent to which futures and cash move together. If they're perfectly correlated, then it's plus 1. And that formula is equal to the covariance between cash and futures divided by the standard deviation of cash times the standard deviation of futures. That's the correlation coefficient. And so we can rewrite the optimal hedge as the correlation coefficient times the standard deviation of cash over the standard deviation of futures, which I think gives you a nice intuitive understanding of the optimal hedge, because let's suppose cash and futures move in tandem fashion. So if cash goes up 1 cent, futures goes up 1%, they move together, so the correlation coefficient is going to be 1, right? And the standard deviation of cash will equal the standard deviation of futures. If they move exactly together, the correlation coefficient is 1, then the optimal hedge is 1, because there's no basis risk. So if that's the case, then the optimal hedge is 1. But it will differ from 1 if the correlation coefficient differs from 1. And it's just a matter of plugging in the correlation coefficient and the standard deviations into this formula to determine the optimal hedge. I'll come back to this, I think, on Wednesday. So why don't you try to read this in the chapter, and I'll spend 5 minutes on it Wednesday. Okay?